Stocks continued to gain ground last week, with Wall Street notching fresh record highs while the dollar rallied for a third straight week, even as Treasuries took something of a pause for breath. A bit of a quieter week awaits the financial markets this week, with Friday's PCE figures out of the United States highlighting the data docket, along with inflation from Canada and Australia as well. Plus, of course, we have month, quarter and half-year end in the mix as well. Plenty for myself and Ryan Littlestone to discuss on the trade-off this week. Without further ado, let's get into the show. So a little bit of a quieter week ahead, but no shortage of topics for myself and Ryan Littlestone to discuss. Let's bring Ryan into the show from Forex Flow Live and Forex Analytics, of course. Ryan, a very good morning to you. It looks like the British summer has finally arrived at last.
Yeah, you know, they say when you see the sun out here, you have to take a photo. And I've been doing that for the last 5 years, taking a photo of the sun. Do you know how many photos I've got?
He's only got 3 photos after all that.
No, I managed to get 5. So there
5.
we go.
Oh, right, blimey.
One a year.
It is lovely, though, that the sun is finally out. The city looks a lot more like it does in your background at long last. Blue skies everywhere. And the market is certainly striking a relatively positive mood as well, with risk continuing to rally, even as we see stocks like Nvidia begin to roll over a little bit, of course, down about 13% from the peak. But in any case, plenty for us to discuss. So let's get into topical thunder and get our teeth into some of these topics this week. Right, so I want to start with that building over Ryan's right shoulder, which is, of course, the Bank of England, because the BOE have put August as live for the first rate cut. Last week, the MPC voting 7-2 to maintain bank rate at 5.25%, as expected, and as markets had fully priced in. We've still got Ramsden and Dingra dissenting in favour of a 25 basis point cut. The policy statement, as well as the vote split, of course, was largely a carbon copy from that delivered after the May policy meeting, with the MPC continuing to see a need for policy to remain restrictive for sufficiently long, maintaining a focus on signs of inflation persistence, and keeping under review how long bank rates should remain at its current level. But there was a new line from the BOE in that decision to hold rates, and that new line is that the decision to hold was, and I quote here, finely balanced for some on the MPC. And those some policymakers, which we'll get onto in a second, appear to be primarily looking through what remains very sticky and stubborn services inflation at 5.7% in May, and instead focusing on the fact that headline CPI in May as well is now back at the 2% target for the first time since the middle of 2021. Now, interestingly, the BBC's economics editor Faisal Islam reports that some refers to 3 policymakers on the MPC. I must clarify, I've got no idea where he got that from because it wasn't in the minutes or the statement. But if we do take him at face value, and he says that those 3 also include the governor, Andrew Bailey, then it doesn't take a mathematician of world-class standards to work out that those 3 plus the 2 already voting for a cut gives you a minimum of a 5-4 majority to lower bank rate if those 3 come over into the cut camp. So I think August is now well and truly live. I've got even more conviction in my call that the BOE are going to deliver the first cut then, in conjunction, of course, with the new monetary policy report and updated economic forecasts. I think we'll probably see another cut in November after that as well. But what's interesting is that although we've seen a dovish repricing of the OAS curve here in the UK, the market still only prices about a 66% chance that the BOE do cut at that August meeting, which in my mind seems a little bit underdone and could put some further pressure on the pound, which I'll get onto a little bit later on, if we do see a further dovish repricing in the next 6 weeks or so. And you would expect that dovish repricing to be primarily driven by the June inflation data, which we'll get towards the middle of next month. So, Ryan, I think when we spoke previously, you were talking about a potential dovish surprise for the BOE. Does that finely balanced line meet your dovish expectations?
Yeah, I think it does. I was expecting a bit more from the votes to maybe, give that signal that a rate cut's coming, but they went 7-2, and that was at my more undovish end of the scale, shall we say. But yeah, though that line that the decision was finally balanced was the real kicker for that one. And again, we're really only just trading the calendar here. You know, we know they're going to be cutting. It's just a question of when. You know, I thought that the odds had risen that they'd cut at this meeting, and you know, I'd been an August man, as you know, for quite some time, and it looks like it's on the table now. The inflation data will be important. If we see a move up in the next inflation number, then, you know, we could see the market going the other way and pricing even less chance of an August cut and pushing that, you know, forward to September or something like that. But in the grand scheme of things, it doesn't really matter. Inflation's going the right way for now. As long as the path doesn't change, they're going to cut at some point, whether it's August, September, November, whatever the meeting is. So we're not getting these big moves in the currency and other assets, the same as every other central bank, you know, when we're just trading around the calendar, not whether there's a cut coming at all. So, yeah, whether it's August, whether it's September, it doesn't really matter at this point in time. But I think you're right. The market is going to trade around those expectations in small part. And obviously, we're all data watching to see what happens.
Indeed, yes, we are. We're all data watching and we're all calendar watching as well. Right, let's move on to the US housing market. Now, is it built on foundations of sand?
Oh, God. Look, I had the pun. I had the pun already in there. You know, cracks appearing. Come on now. You know, you're trying to steal my limelight now. But, yeah, I thought mine's certainly a better pun than that one anyway.
Well, it's a low bar, mate. Let's be honest. It's a very, very
yeah,
low bar. Very
low bar indeed. Yeah, you trouble some limbo dancers with that bar. Anyway, he's gone again. Look, careful now. We'll see that penalty spot
Carry
again.
Carry on.
All right. So last week I flagged the US housing data, starts and permits as a data point to watch in the flood of data we got last week, and both dropped for the third consecutive month. That also came as the National Association of Home Builders Index also dropped back as well. This week we get US house price data and some housing sales numbers, new sales, existing sales and the like. And it's important to know the distinction between those two different sets of numbers. The NHAB and the housing starts and permits are more on the construction side of the industry, whereas prices and sales are more on the consumer side. Now we're seeing this weakness in the construction side right now, which makes me think that we're perhaps now really just starting to see some of the real effects of these higher rates kicking in to the economy. That side of housing is more reliant on big corporate financing as opposed to mortgages on the consumer side. So if there's a squeeze on that side, it might not be too long until we see similar on the consumer side. I mean, I'm already hearing anecdotal evidence that outside of big cities, people are becoming more reluctant to move due to the higher rates of mortgages. Now, if we start to see similar weakness in sales and prices this week, then the snowball might be rolling for whether we're going to start to see some real weakness creeping into the US economy. Now, housing is a very early indicator for conditions of an economy and whether it's facing problems or not. And if I see these sort of data points, you know, starting to trend south as we are with the starts and permits, I think it could kick the Fed into cuts sooner than the market is expecting, and that could mean we see the US dollar heading south.
Yeah, it's an interesting one. I mean, I think your point in terms of the reluctance to move is something that's actually dominated most of this economic cycle, because particularly in the United States, you've got people locked into 2.5%, 3%, 30-year fixed rate mortgages. Unless you're able to port that mortgage to a new property, you're not going to give that up for something that is, double or even triple the interest expense on that loan, on that mortgage. So I think that is a characteristic of this cycle that we will come back and look at when it's all said and done and when the Fed have normalized policy. The one place I disagree with you is well, actually, two places I disagree with you. One is that it would force the Fed into sooner rate cuts. I think you'd need to see a sort of absolute disaster within the housing market in the United States for that to elicit a policy response. I think the focus is primarily on inflation and on the labour market, of course, at the moment. And the second is that if, or indeed when the Fed cut, because they are going to cut, let's be honest, that will cause a leg lower in the dollar. And I'm not so sure it will, because that easing will still be relatively coordinated and relatively synchronized with that of their G10 peers. I mean, the ECB have already gone, the BOC have gone, the BOE are probably going to go in August, as we discussed. So I'm not sure that the textbook rate cut equals softer currency equation perhaps is as strong this time around as it has been in past cycles.
Yeah, it's one of these situations where, it all depends on the data. At the moment, yes, we've seen, starts and permits, 3 negative months, okay, but it's not collapsing. And even if people aren't moving on the sales side, what they are doing is they're extending properties. They're making them big enough to get in-laws moved in and that sort of thing. So they are still spending money on properties. It's not like everyone's going, oh, we're not moving and we're not spending and the market's going to grind to a halt. But I think where this data plays in is if it starts trending lower, is it going to be a soft landing type move, or is there going to be a nosedive? And, as traders, we need to watch the data and decipher that. If things head for a bit of a nosedive, then the Fed will be forced to cut sooner and probably cut quicker thereafter. So it's, I'm not saying in the month's time they're going to start cutting rates, but it's the question, when they do start cutting rates, how far will they start cutting? At the moment, the market's not prepared for a quick cutting cycle. And I think just to have that in the back of your mind and let the data, convert to that or not, is what we need to look for.
Yes, no, that is a very, very good point. It's always important to be aware of what the market is discounting and the risks, of course, to that view on both sides, although you would argue at the moment that the risks are tilted much more in a dovish direction. I think only Dick Matthews is calling for a hike still. In any case, let's move on to what is, in my view, going to be the key determinant of when the Fed deliver that rate cut, and that is, of course, inflation. We get the latest PCE figures out of the United States this week. And as I said earlier on, it is a bit of a quieter week for financial markets this week, lacking a little bit of top tier economic data. And I was having this conversation with somebody the other day, and actually this is somewhat typical towards the back end of the month. If you think about when economic releases are typically scheduled, the jobs report is always, nearly always, the first Friday of the month. Very rarely it's the second. The CPI figures are typically out in the second week of the month. The PMIs are normally the first Monday and Wednesday of the month, the first and third working day of the month, however they fall. And as you get towards the back end of a month, things do tend to quieten down a little bit. And that is, again, what we're seeing this time around. So it's by no means unusual. But of course, amid that quiet economic calendar, Friday's PCE report will be the highlight and the standout risk event, with core PCE, obviously the Fed's preferred inflation metric. Now, the core PCE deflator, that is expected to fall to 2.6% from 2.8% previously on a year-on-year basis. If that's in line with expectations, that would, of course, be the lowest level for the core PCE metric in just over 3 years, and a sign of further progress in disinflation back towards the FOMC's 2% target. Now, the chances of a surprise, and I don't want to be a hostage to fortune here, with PCE are typically relatively low, because it's actually quite straightforward for most on the sell side to take the CPI, the PPI, the import price, the export price metrics, and extrapolate from that where PCE is going to be. And on a monthly basis, the core PCE print is seen at 0.1%. That's just a tick lower from the 0.2 that we saw previously, and will be the lowest since November of 2023, which is, of course, more good news for Chair Powell and his colleagues. Now, as I said, you can extrapolate the print relatively easily, so any volatility, barring a knee-jerk move as the data drops, could perhaps be relatively limited. Although I would say that data in line with those expectations would provide further support for what is my base case, and I think is still the consensus, for the first Fed cut to come at the September FOMC meeting. Although, as with the BOE, the market looks to be a little bit underdone on that. Currently seeing that, when I checked just a moment ago, as around a 70% chance that the Fed do kick off the easing cycle in September. So if we do get some further signs that disinflation is continuing, then perhaps the market will begin to move to price in a marginally greater probability of that cut coming in September, albeit, of course, with the caveat that there is still a hell of a long way left to run until then, and a lot of data in the interim as well.
Yeah, I can agree with that. I think as all these CPI reports that we're getting from the US, it's a question of, is it going the right way, or is it going to be more sticky? And the more times it's sticky. And if we get those odd moments where it goes up, then obviously the calendar changes yet again, and the market prices out 1 month and pushes all their expectations forward. Doesn't mean too much for the currency outside of a bit of an algo move over the data. But yeah, this is definitely one that traders are going to get their teeth stuck into. We hope there's traders for a decent variation in the number just to give us that trading volatility. But yeah, maybe a bit of a surprise because, yeah, the market does all that extrapolating, but this has been steadily coming down and down and down and down, whereas we've seen CPI going sideways for a year. So maybe we get a bit of feed through into that, and maybe this starts easing off. That's at least the main risk for these numbers, that we don't continue to fall. We maybe start going sideways above that target for the Fed, and then we're back into higher for longer mode and the message from those guys.
Indeed, yes. Can I just speak for the rest of the market apart from you, in that the PCE figures are going to be dropping on a very, very sunny Friday afternoon in the City of London? I think almost every market participant is hoping that there isn't a surprise so that they can go out and enjoy the nice weather with a cold beer relatively early on Friday afternoon. But if you want your surprise, mate, and to be stuck at your desk, then, help yourself.
Well, I don't know, folks, but that sounds to me like someone's hankering for a half day on Friday. Some of us will be working and watching the data. It sounds like you will be disappearing down the pub, mate.
Every Friday's a half day. Right, let's move on. I made a joke yesterday, actually. I think Ryan may have read it, that this week is, of course, the end of the month. It's the end of the quarter. It's the end of the first half of the year as well. So as a strategist sitting here and you see a move that doesn't make sense, what do? It's all down a month-end flows, isn't it, mate?
Absolutely, yeah. Everything's month-end flows, but it's that time of year where we need to pay attention, particularly to the fixes during the day. And later on this week, you need to keep an eye on the clock for every time it hits the hour mark, because we can get some moves around that period as well. As you said, it's month-end, quarter-end, half-year end, and this is one of the big trading periods of the year for that. Now, aside from the usually month end and quarter rebalancing, what happens at this time of year for half year end is that a lot of financial firms can sort of start booking some profits for their half yearly profit reports and indeed their calendar fiscal years. Then they get that out of the way and they can start re-putting back on those positions into the new year or their new allocations. So when we get these three ends, let's call them that, at once, it can make trading a little bit more uncertain. It doesn't help either that we're in the middle of two elections, obviously the UK and France, the latter of which kicks off this coming Sunday. So sometimes what happens over month end can distort those market prices versus what's happening in economies with the fundamentals and elsewhere. For me, this is always a period that's one for opportunity. If I see those distortions pushing prices outside of well-worn ranges or against the fundamental picture or underlying picture that we know in economies and a currency. For example, if we see some real euro strength via these end-of-month flows, that would put it against the backdrop of this French election risk, an easing ECB and a European economy that's not exactly going great guns. So if those price moves push the boundaries of some of these long-term traded ranges, that would get me interested. Suffice to say, be careful with moves this week. And, the best advice I can give is do your chart homework, know where the levels are that would maybe mark an extreme move. Be careful with positioning in the euro, as I said, into the end of this week with this upcoming first round vote in France on Sunday, because there is potential for gap risk on Monday, depending on how those votes go. But keep an eye on the clock, know your levels. If you do see a big move, match it off against what's happening with the economy in question. Is that a move that's outside and the picture's been distorted? Because that can present an opportunity for a bit of a fade trade.
Yeah, absolutely. I fully agree with you. Sorry, I was just checking for a research note that I read on the train in this morning, because for what it's worth, and I don't really put much faith in these models, both Barks and Citi say that there's going to be dollar selling into month end, which probably means the dollar's going to rally into Friday, let's be honest. But I think you're absolutely right in terms of the way to manage end of month and end of quarter flows. Of course, risk management is the first priority, but they do perhaps present present some degree of opportunity if we see the market move significantly away from what are actually across the G10 world pretty well established and relatively narrow trading ranges at this moment in time, which we'll of course get onto in a moment or two. And yeah, absolutely, over the weekend we do have that gap risk potential in the Eurozone, and of course before that we may see some hedging and some risk being trimmed into the close on Friday, as participants would rather just close out, ride out the election flat, and then reopen those positions on Monday morning if they see fit.
Yeah, and it's important to remember as well that Wednesday and Thursday are the important corporate dates, because they're the value date end of month, and obviously because we've had that move to T1 settlement for the US, Canada, and Mexico, so you've got Europe and the rest of the world, UK, their value date is Wednesday. For the others, the value date is going to be Thursday.
Yes, indeed. Although, actually, I don't want to go off on a complete tangent here. Did you see the SEC are now having a go at us here in the UK to try and get us to move to T+1 more quickly? I mean, that is possibly the most American thing ever. It sums them up, doesn't it? We've done it. The rest of the world has to follow, and you don't have a choice.
Yeah, I saw that as well. Yeah, well, we'll probably take about 8 years to have consultations on the whole thing. So, yeah, maybe about 2040 we might be ready.
I'm buying 2040. Right, let's move on to that's a setup. Right, let's crack on. Cable, first of all, I mentioned this a little bit earlier on, but just wanted to throw the chart in the mix as well. As well, literally mentioned 2 minutes ago, most G10s are within what are relatively well-defined ranges, and cable is exactly the same, still in this broad 125 to 128 range that we've traded in pretty much since last December, albeit with a brief foray to the upside in early March and a brief foray to the downside in late April. Besides those couple of trading days, we have been in that range for the last 6 months or so. As I mentioned earlier, I think downside risks to the pound are starting to grow a little bit. I think the BOE are pretty much all but nailed on to cut rates in August at this point, barring a significant inflation surprise. Yet, of course, the OAS curve prices just a 2 in 3 chance of them doing so. As a result of that, I think the bears would be emboldened if we get a closing break below the 50 and or the 100-day moving averages, which come in around 126.25 and 126.40 respectively. And of course, the obvious downside targets from them would be the 200-day moving average, followed by, of course, the 125 figure, which has been the bottom of that range that is very, very well defined. So I think the balance of risks is starting just a little bit to tilt increasingly to the downside for the pound at this moment in time.
Yeah, I don't think it's going to go anywhere fast, though.
Absolutely not. It'd be a glacial move.
Yeah, probably. We might get a reaction, a sort of confirmation move over the Bank of England when they do start cutting. But as we're seeing for the Canadian dollar and the BOC and the euro and the ECB, the market's ready for cuts. When they start, you might get a minor move, and then that's it. We're back in the range. So cable, it does have a tendency to move a bit faster than some of the others. So that might be a good thing. If you see a downward move in something like cable and it hits down towards the bottom of that range, 125s, I'd certainly be interested in picking up along, depending also what's going on the US side. But I'm a big player of euro sterling, as you know, and that's glued at the moment in between sort of 84.80 and 84.20. So that's not going anywhere. And so again, if you see a bit of a move there, just a knee jerk on the back of the BOE, then again, that might be something I'd look at as an opportunity just for it to stick into range.
Indeed. Yes. Right. Let's move on. I can see that you've stolen my yentervention pun that I coined a little while ago.
Oh, no, you didn't. I had that one. We probably both stole it off someone else, but
I think I nicked it from Reuters, actually, to be fair.
They nicked it from me. There you go. So yentervention. My pun is back on the agenda. Now we're past the Bank of Japan meeting and the Japan CPI data, which came in the right way for the Bank of Japan in the end. We find ourselves trading up again and back close to that 160 level, that prior high that we hit previously. We're starting to get a more steady stream of comments coming out of MOF officials and perhaps the market is getting a bit more nervous about being short the yen. Yesterday, we had a whole big wobble out of nowhere in the morning. Not this one, dollar yen down around 90 pips in a blink, but then it recovered pretty fast afterwards. Again, to repeat, there may be some strong influence of end of month flows coming into this pair. That also could muddy the waters somewhat. However, from a fundamental perspective, the Japanese data thus far in the new fiscal year has been coming in better, and as I say, the right way for the Bank of Japan to look at hikes and keep those on the table. Yet we're not seeing any gains thus far in the yen on the back of it. So that's very important. We're getting this data that's leading the Bank of Japan to be okay and to look towards tightening further, but yen isn't reacting the way you'd expect it to do. That's a big fat red warning sign that the Bank of Japan tightening does not mean automatic yen strength. Now, technically, we're close to these prior 160 highs, and up there, we're pretty much on the dot where we hit that high previously, is a level that goes back to April 1990 and even back into the mid 80s. So that's really the focal point here. If we break that, it could be another watershed moment where we're talking about, maybe running up to 170. Now, obviously, the higher we go and the faster we do it, the greater the intervention risk will grow. But right now, even if they intervene and the Bank of Japan go and hike, and there's sounds that they might be doing something in the July meeting, it doesn't look like anything or anyone can keep the yen from weakening further. And so it might only need or be a big negative turn in the US that can finally stop this pair at least. So for now, be careful of that intervention risk. But it seems I really don't know what's going to stop this from rocketing higher still.
I mean, as you said, the key point with intervention is not where dollar yen spot is trading necessarily. It's the speed of the move and the volatility that we're seeing. And of course, whether the Japanese authorities judge the move to be out of line with the underlying economic fundamentals that they believe should be moving dollar yen. So as we said, the last time this was on the agenda, it's not a case of the Ministry of Finance won't let dollar yen trade higher. They will, but only to a certain degree and at a certain speed, because their focus is, of course, on trying to stamp out speculation rather than targeting a specific currency peg like we see, or like we saw with Euro Swiss, for example, back in the day, or like dollar Hong Kong, which is within a trading band. That's not what's going on here. I think the other thing, though, that just speaks to the amount of nervousness in the market is when we did see that quick big figure move lower in dollar yen mid-morning yesterday, the number of emails and calls that I got within about 10 minutes of that going, was it intervention? What do you think it was? Are they stepping in? And all the rest of it. I think that says quite a lot about where sentiment is at the moment.
Yeah, very much so. The last intervention is still fresh in the mind, and no one wants to be on the end of a quick 350, 400 pip hit. So anyone who's short these pairs, you're paying the carry, so you're sort of double nervous because it's costing you money to sit in a trade. But you get that intervention and you're through your stops and potentially gapping down. So the market knows. The speculative side of things has calmed down a bit. In fact, Japanese retailers are on the other side. They're getting into shorts in this pair purely to try and catch an intervention. But that's another thing. The higher it goes without that intervention, maybe those guys will fold and actually adds to the move higher. So there's a lot going on in this one as always, and you need to be careful.
Indeed, yes. Right, moving on, the S&P 500 long risk is, of course, continuing to work well. The S&P is up 15 or so % on the year now, and up just over 10% from the mid-April lows. It does appear that the bears are getting louder and louder at this moment in time. Last week seemed to be dominated by every man and his dog, or every person and their dog maybe these days, talking about narrow market breadth and how only a handful of stocks are leading the way higher. Of course, now we've had Nvidia starting to roll over a little bit, down just over 10% in the last 3 sessions, and the bears are now latching onto that one. Personally, I don't think that matters particularly much. I mean, look at the chart. The market shrugged off how narrow the leadership was for pretty much the entirety of 2023, and it's managed to do so for much of this year as well. And I certainly don't think a high degree of concentration is a reason to be looking to short the market, particularly when we continue to set fresh record highs on a relatively regular basis. And actually, to steal from a Morgan Stanley note, which I read yesterday, over a 1 month horizon, breadth is as narrow as it's been, going all the way back to 1965, but the average return 6 months from now, after breadth is defined as narrow, is around about 4 or 5%, depending on the index that you look at. So I certainly don't think that is a cause to concern yourselves, although, of course, past performance is not necessarily a reliable indicator of future returns. I have to say that. Nonetheless, other factors in the mix. The Fed put is still here. Earnings season is just a couple of weeks away and should add further fuel to the fire if we do see strong earnings and, of course, strong guidance to go with that. Plus, some seasonal trends in the mix too. Over the last 5 years, July has been the second best month of the year for the S&P 500, and the index has gained for the last 9 years in a row. If you look at the NASDAQ, that is 16 straight years of gains in the month of July. So personally, I remain long and will be happy to buy into any weakness that we may see, which won't surprise anyone.
No, indeed, always go with the trend, as we say. And yeah, I don't know what to say about this one. It just keeps confounding everyone. People keep trying to pick tops, trying to, find indicators where things all stop, and it just doesn't. It just keeps going and going and going. It's hard to trade for someone who, like myself, I use technical analysis, but when you're in uncharted territory, we don't have price history to rely on. So you can't rely on old support resistance areas. You've really got to switch down to the shorter term charts and just let the levels develop, see where the top comes in. Just making one top and dropping back doesn't mean a thing. But if you then hit that top again, that high again, and it holds, 2 days later, that tells you something more is happening, and you've got something to lean on. You've got a level to lean on that if it goes through, the trade's wrong and it's going to keep going. So, yeah, don't try and pick tops in this one until you get evidence that there's something more than just a 5-minute top in play.
Yeah, absolutely. And the other thing is, if you are trying to pick tops in the market, and I naturally have a relatively bullish persuasion, but go back over the last 5 years, even over the last 10 years, I ran the numbers on this a couple of weeks ago. 60% of all trading weeks, the S&P has ended in the green. So you are very much sort of fighting the trend. If you are looking to go short. And as we always say, the trend tends to be your friend with markets. And that applies not just to equities, but of course to markets more broadly.
Yeah, and it's dangerous as well because, you see it make a new high and you think, oh, you get the FOMO and you think I should be buying this. The trend is quite clear. I should be buying this, but you don't really get a dip that's good enough to get into. So that's where you get some of these little volatile moves. Sometimes you get people who have chased it at the top, doesn't make a new high, and then they go all panic, and then they all get out, and that's when you see a dip, and everyone goes, "Oh, the top's in," because we've seen a decent dip, and then no one wants to buy it on that dip. So it's a very difficult market to trade sometimes. But let the price action be your guide and pick it up off the charts from that.
Absolutely, that is all you can do. Right. Last but by no means least, the euro.
Yeah, looking at the euro, we've spoken about the election risk, and there are some big risks here. And I wanted to expand on the risk for the euro this week and just take a bit of a closer look. The waves from the French election news are calming, and some of the stories out of France recently suggest that the Le Pen's party might be looking to moderate some of their policies from the big hardline policies that they've been pumping for years. Now, that might be calming markets at the moment somewhat, but as mentioned, again, it also might be a case of these end-of-month flows masking that election risk. So I'm looking at euro dollar with a bit of a short bias at the moment, particularly if we see a big rally for over month end. For me, this is one of the cleanest charts to pick and watch those levels. The high 108s, 109s is an important area to watch, as is the bigger 110 level. If we see a move to those sort of areas without any help from central bank speakers or any of the data, I'm going to be seriously thinking about shorts between now and, as I say, into the end of the week. Now, if I'm in any shorts and I decide to run it into the election weekend, I may hedge that with maybe a topside put in the options just to give me some coverage for those elections. Because, we know voters have been saying one thing in the polls, but, polls are pretty pointless. It's how they intend to vote in the real thing that counts. The market itself would like to see a Macron win just to keep the continuity, but I see the risk, see the risk that there's more outcomes going against that than for it. So that's why I'd be happy to be positioned that way with shorts. If we do see a downside move, be it on the events this week or the election, 105 could be in the frame for a visit. It's a level I've traded previously and another huge long-term level to watch too. I know Michael will be happy if we trade down there for our bet, but if we do, hopefully it trades 105.05 and he doesn't get a win on that one. So anyway, down to that 105 level, it would be rude of me not to look at that from longs from there if, and that's a big if, the French election news isn't a game changer.
Indeed. I have very little to add to that. I was going to bring up our lunch bet, but you already have. All I will say is I hope we trade 104.99 rather than 105.01, just so that I can get a free lunch out of you. Right, let's move on to our plays of the day. Right, I'm looking at gold this week, and well, you may call it sitting on the fence, but I would rather call it a little bit of patience. The yellow metal trading back below the 50-day moving average in early trade as the new trading week gets underway, although we're still within this relatively broad 22.75 to 20. Jesus, let me start that again. We're still... You can tell it's early. We're still within this broad 22.75 to 24.50. There we go, range that's been in place for a while now. All the time we're below the 50-day moving average, then I favour selling rallies towards the bottom of this trading range, 2300 and then 22.75, the two levels that I would be keeping an eye on. And then if we get a closing break north of the 50-day moving average, then I'd be actually looking to trade this from the long side up into those three levels above that I've highlighted. I think there's a couple of ways to play it. As I said, I'll let price give the steer on this one. I don't have a particularly huge bias on gold either way at the moment, although of course there are a couple of risks on the horizon. Firstly, the PCE figures out of the US on Friday, and then of course Friday could also be a relatively messy one if folk do want to start hedging their exposures and looking for safe havens such as gold to hedge and mitigate any potential election risk over the weekend. But nonetheless, that is my play of the day this week. Ryan, we're going over to Canada.
Yeah, the land of beavers and syrup. That's where we're heading for this one, and I'm looking for a potential CPI dip on this one. We've got Canadian CPI out today. It's Tuesday, and while it's been going the right way for the Bank of Canada to start cutting and indeed promising more cuts, there still may be some bumps in the road for inflation. The loonie is right on a level here as we speak, 136.50, and I'm looking for a long here market. I've actually taken that last night, but I'll also add into the bigger 136, 135.85 area. You can see there it's a big old solid support zone there. There's a ton of tech confluence there from moving averages and the fib, as you can see on the chart. And maybe CPI will give it the kick down to that level. If I do get filled there, I'll have a stop sub 135.70. So a nice level trade for this one.
Good stuff. Thank you, mate. Well, that does bring us to the end of another show. Thank you very much, as always, for watching, and also to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. I hope you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, or if there's anything you want us to discuss in the next episode. And we will be back with that episode this time next week. In the meantime, thanks very much again for watching. Goodbye.